Now, of course, we did hear from Jay Powell yesterday, so let's just remind ourselves of what happened with this basis point hike and his approach going forward.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Well, the Federal Reserve slowed down the pace of its rate hikes yesterday, and while Fed Chair Powell struck a hawkish tone at the press conference, are markets set to believe his message, especially based on what we're seeing now? Well, for more on the market action from yesterday's Fed meeting, let's bring in Yahoo Finance's Blikre to break this down for us. Hey, Jared.
Hey there. You might remember this graphic from about 24 hours ago. We had two possible choices, Powell being hawkish or dovish. Guess what? The hawkish tone prevailed. So this comes with a slower to pivot. So in other words, rate hikes are going to continue longer than expected. And then risk assets that include stocks, commodities, crypto, those are going to be flat to down. And in fact, they did sell off pretty handily yesterday. Let's take a look inside the market action. Now, this is a 3-month chart of the S&P 500. I also said 3,900. That's about where we are right now, to 4,200, 4,150, 4,200. Huge kind of neutral area until we punch through this level or to the upside out of this box here. Probably going to be not going to have a lot of directional input here. But once we do break the range, probably going to get some momentum off of that. So let's take a look at some of the sectors that were hardest hit yesterday. Powell spent an inordinate amount of time talking about the hot labor market. I think it's clear he's going to engineer a recession, but considering how far the Fed was behind the curve, they had to do 4 75 basis point rate hikes in a row. Considering how far they were behind the curve, you have to imagine when reality is going to catch up. Now, the market is dialing in, the market is pricing in a Fed rate cut by the end of the next year. And the Fed officials, according to the SEP yesterday, they were indicating that they're actually going to be raising the rate additionally to 5.1%. So there's a huge disconnect between what traders think are going to happen and what the Fed says is going to happen. That's showing up in weakness here. This is today's sector action. Tech taking it to the downside, followed by communication services. That's where you're going to find the Meta ticker and as well as some telecommunication tickers. Materials also down 2.5%. These are the underperformers. And you take a look at the 2-day, you can see communication services, tech, materials again, and also financials. So let's begin with financials. Banks very sensitive to the yield curve. Didn't like the message yesterday. So this is over the last 2 days. You can see, well, this is the energy market. Let's take a look at the banking sector right now. JP Morgan down 2%, Bank America and also Wells Fargo down 3%, Morgan Stanley down 5%. And then you take a look at what happened with the semiconductor sector. Now, I think this is key here because you're not necessarily seeing this with software. Semiconductors, chip stocks in particular, very levered to the cyclicality of the economy. So we got NVIDIA down 7%, Taiwan Semi down 3%, AMD down 7% as well. So the winners and losers here are becoming clear, and it's mainly the losers to the downside.
So, Jared, what does this all mean heading into 2023? What can we expect to see at the start of the new year?
Well, first, interesting tidbit from the press conference. Powell probably not going to move the goalpost on that 2% inflation target. There was some speculation around that. He left it for a later date, a much later date, pretty much tried to take it off the table. But I think the writing on the wall is clear here, Akiko, that the Fed is going to engineer a recession. And the question is, how much damage has the aggressive rate hike schedule that they've already engaged in? How much is that going to hit the economy in the new year? And how is that going to change the Fed's evolving view of the economy? The analysts, the macro analysts I'm talking to and looking at, they have a pretty dim view of the economy, and they're looking for shorting opportunities in the major markets into early next year, notwithstanding whatever might happen in the next few weeks with the Santa Claus rally. So that's big picture stuff.
We're still holding out hope for that Santa Claus rally.
Yes.
Jared Blikre, thanks so much for that.